Everyone, you are watching Financial Management with Raveendra Hegde. Dear students, in this session, let us study three important issues. Let us discuss scope and significance of financial management. Let us focus on the approaches of finance function and also examine the relationship with other disciplines. First, let us see the scope of financial management. As an integral part of the overall management, financial management is mainly concerned with acquisition and use of funds by an organization. Based on financial management guru Ezra Solomon's concept of financial management, we can have four important aspects. One is determination of size of the enterprise and determination of rate of growth. Determining the composition of assets of the enterprise. Determining the mix of enterprises financing, that is consideration of level of debt to equity and so on. And finally, analysis, planning and control of financial affairs of the enterprise. Students, the scope of financial management has undergone changes over the years. Until the middle of this century, its scope was limited to procurement of funds under major events in the life of the enterprise, such as promotion, expansion, merger, and so on. In the modern times, the financial management includes, besides procurement of funds, the three different kinds of decisions as well, namely investment, financing, and dividend decisions. The picture, what you are seeing on the screen, depicts the overview of the scope and functions of financial management. It also gives the interrelation between the market value, financial decisions, and risk return trade off. The finance manager, in a bid to maximize shareholders' wealth, should strive to maximize returns in relation to the given risk. He should seek courses of actions that avoid unnecessary risks. To ensure maximum return, funds flowing in and out of the firm should be constantly monitored to assure that they are safeguarded and properly utilized. So these are about scope of financial management. Now let us understand the significance of financial management. Importance of financial management cannot be overemphasized. It is indeed the key to successful business operations. Without proper administration of finance, no business enterprise can reach as its full potentials for growth and success. Money is to an enterprise what oil is to an engine. Financial management is all about planning investment, funding the investment, monitoring expenses against budget, and managing gains from the investments. Financial management means management of all matters related to an organization's finances. The best way to demonstrate the importance of good financial management is to describe some of the tasks that it involves taking care not to over invest in fixed assets, balancing cash outflow with cash inflows, ensuring that there is a sufficient level of short-term working capital, setting sales revenue targets that will deliver growth, increasing gross profit by setting the correct pricing for products or services, controlling the level of general and administrative expenses by finding more cost efficient ways of running the day to day business operations, and tax planning that will minimize the taxes a business has to pay. Now, let us examine the approaches of finance functions. Value of a firm will depend on various finance functions or finance decisions. It can be expressed as V is equals to F of I F D. Here F indicates function, I means investment decisions, F indicates financing decisions, and D means dividend decisions. The finance functions are divided into long term and short term functions. Now let us examine the long term finance functions or decisions. There are three types: investment decisions, financing decisions, and dividend decisions. The investment decisions relate to the selection of assets in which funds will be invested by a firm. Funds procured from different sources have to be invested in various kinds of assets. Long term funds are used in a project for various fixed assets and also for current assets. The investment of funds in a project has to be made after careful assessment of the various projects through a technique called capital budgeting. A part of long-term funds is also to be kept for financing the working capital requirements. Friends, asset management policies are to be laid down regarding various items of current assets. The inventory policy would be determined by the production manager and the finance manager, keeping in view the requirement of production and the future price estimates of raw materials and the availability of funds. The next one is the financing decisions. These decisions relate to acquiring the optimum finance to meet financial objectives and seeing that fixed and working capital are effectively managed. The financial manager needs to possess a good knowledge of the sources of available funds and their respective cost, and needs to ensure that the company has a sound capital structure, that is a proper balance between equity capital and debt. Such managers also need to have a very clear understanding as to the difference between profit and cash flow, bearing in mind that profit is of little avail unless the organization is adequately supported by cash to pay for assets and sustain the working capital cycle. Financing decisions also call for a good knowledge of evaluation of risk. For example, excessive debt carried high risk for an organization's equity because of the priority rights of the lenders. Next is the dividend decisions. These decisions relate to the determination as to how much and how frequently cash can be paid out of the profits of an organization as income for its owners or shareholders. The owner of any profit making organization looks for reward for his investment in two ways: the growth of the capital invested and the cash paid out as income. For a sole trader, this income would be termed as drawings, and for a limited liability company, the term is dividends. The dividend decision thus has two elements: the amount to be paid out and the amount to be retained to support the growth of the organization. And remember, the level and regular growth of dividends represent a significant factor in finding a profit making company's market value. That's the value placed on its share by the stock market. All three types of decisions are interrelated, interlinked. The first two pertaining to any kind of organization, while the third one, that is dividend decision, relates only to profit making organizations. So it can be seen that financial management is of vital importance at every level of business activity, from a sole trader to the largest multinational corporation. And now let us talk about short-term finance decision. Working capital management is the short-term finance decision. Generally, short-term decisions are reduced to management of current asset and current liability. This is called as working capital management. Now let us examine the relationship of financial management with other disciplines. The accounting and marketing, production and quantitative methods department give very good support to the financial department in finding the working capital management, in calculating the source and cost of funds, investment analysis, determination of capital structure, in the formulation of dividend policy, in analyzing the risk and returns. Financial management and accounting are closely related. For computation of return on investment, earnings per share, and of various ratios for financial analysis, the database will be accounting information. Looking at the hierarchy of the finance function of an organization, the controller reports to CFO. Accounting is one of the functions that a controller discharges. Accounting and finance are closely related. Without a proper accounting system, an organization cannot administer effectively function of financial management. Now let us see the relationship between financial management and marketing. Many marketing decisions have financial implications. Selections of channels of distribution, deciding on advertisement policy, remunerating the salesman, etc., have financial implications. In fact, the recent behavior of rupee against US dollar affected the cash flow positions of export oriented textile units and BPOs and other software companies. Now let us talk about the relationship between financial management and productions. Finance and operations management are closely related. Decisions on plant layout, technology selection, productions or operations, process plant size, removing imbalance in the flow of input material in the production process, and batch size are all operations management decisions, but their formulation and execution cannot be done unless evaluated from the financial angle. Let me give an example. Infosys does not have physical assets similar to that of Indian Railways. But if both were to come to capital market with a public issue of equity, Infosys would command better investors' acceptance than the Indian Railways. This is because the value of human resources plays an important role in valuing a firm. The better the quality of manpower in the organization, the higher the value of the human capital, and consequently, the higher the productivity of the organization. Indian software and IT enabled services have been globally acclaimed only because of the manpower they possess. But it has a cost factor. That is the best remuneration to the staff. Financial management quantitative methods are also linked together. The tools and techniques of analysis developed in the quantitative methods discipline are helpful in analyzing the financial management problems. So, the marketing, production, and quantitative methods are only indirectly related to day decision making by financial managers and are supportive in nature, while accounting is the primary discipline on which the financial manager draws considerably. Students, even economics can also be considered as one of the major disciplines which help the financial manager to gain knowledge of what goes on in the world outside the business. Now, let me share one beautiful thought by Rahul Bajaj. If you could have an entrepreneur in every family, India's economy would skyrocket. We would then be able to take our rightful place as an economic superpower in the community of nations. Entrepreneurs create jobs, they create wealth, they create products and services. Today, we have discussed the scope and importance, the financial functions, and relationship with other departments. Have a nice time. Thank you so much.